Welcome to your Wealth Engine, the show that helps you create, grow, and protect your wealth through the power of free market capitalism. It's 7 a.m. here in beautiful Bangkok, Thailand. In fact, I am sipping a morning espresso. How about you? That's fantastic. Whoa, I've got a big show today. I got a lot of research I've been doing. In particular, the last time that we met, I was talking about inflation. I went through inflation across the world, but now I'm going to be talking about interest rates. So keep in mind that inflation is a component of every interest rate that you see, whether that's a government interest rate, a return on equity calculation, anything that's denominated in interest rate or in percentage terms like that has an inflation component in it. The inflation component is just one part of interest rates. And of course, what we've been seeing is the Fed increasing interest rates significantly across, the last few Fed meetings. We've got a meeting coming up on the 2nd, and I expected the Fed's probably going to increase again. Now, they'd be kind of crazy if they increase by 75 basis points, because that is going to be a major impact on the economy. I would argue that already the impact of rising interest rates is massive on the U.S. economy. But what you're going to learn today is that it's more than just the U.S. economy. Economies around the world are going to get hit. And so let's take a look at, I've prepared a series of presentations that I've been working on. Let's see if we can take a look at what we're going to see. The title of today's segment is Fed-led interest rate rise is spreading pain across the world or worldwide. We're going to talk about the Fed interest rate hiking cycle sweeping across the world. We're going to look at France and Germany and see that they are in a painful game of catch up with the US. We're going to look at emerging market rates and how they have been higher but kept low by China. China is a major situation where inflation is low and interest rates are low, and then frontier markets are suffering the most. We're going to look at rate rise that's reduced global earnings by about 6%. And in developed markets, US and UK are hit the hardest. I've done a huge amount of work to try to estimate what is the impact on this rising interest rate on the earnings of various countries. Corporate interest costs are up about 4.8% to 4.8% from 3.3%, and profit hit at the US, UK, Germany, and Brazil has been hit extremely hard. Also, I'm going to show you a company at the end of today's segment that's a defensive supermarket in Singapore. I find it an interesting story. And we're going to learn some lessons from laws. 3 people I met last week that can help you protect your wealth through the power of their stories. Let's get started with the Fed interest rate hiking cycle sweeping across the world. So the 3-month US, or not US in this case, global government bond yield across the world rose from 1.4% a year ago to 3.4%, which is up 2%. Now, this chart actually looks at every country in the world. It wasn't an easy chart to construct. And so how did I calculate this chart? Let's take a look at what I did. Well, I gathered the 3-month government bond yield across 52 countries for each month over a decade. And then I weighted each of those by that country's GDP. Consider that US GDP was about 26% of world GDP. So its 3.3% government bond rate contributed about 0.9% to the world's 3.4%. Or let's consider Pakistan, where GDP accounted for about 0.4% of global GDP. So its high 14% bond rate only contributed 0.1% of the world's 3.4% 3-month government bond yield. And that's how I calculated this particular chart, which you're going to look at more detail. So let's look at this in more detail. I can then take the data and break it apart between developed and emerging markets. And what we can see is developed markets went from negative 0.2 to 2.2 in 12 months. And emerging markets were already pretty high at 3.7. They were nowhere near where the developed markets were at 0, basically. And they went up to 5.2. And we can get a picture of that from this chart. And I just want to talk for a moment about this because the US is a great example of a country that has a fiat currency. When you have a fiat currency and you have the power of it also being a reserve currency, that's the key, that it's a reserve currency. What you're going to find is that that reserve currency, basically, you can lower interest rates all the way down to 0, and it's not going to hurt the currency too much. But if a country like, let's say, Thailand, as an example, or I showed Pakistan in the past, were to lower their interest rates down to 0, then no money would come into the country to buy their corporate or their government bonds. And the result of that is that there would be no demand for the currency, and it would eventually cause the currency of that country to devalue. So being a developed market with a reserve currency status like the US means you have the privilege of running interest rates down at basically 0. Now, there's a lot of stuff I'm covering today. So as I go through this, if you have any question on this topic or anything else, make sure just to type it into the chat. So let's continue on and try to summarize what we've just said. What are the key points and the bottom line? Well, the GDP weighted 3-month government bond yield across the globe rose to 3.4% from 1.4% a year ago, which is up a massive 2%. I mean, that is huge. Developed markets have gone to 2.2% from basically 0, which is up 2.3%. Emerging markets have gone to 5.2%, up from 3.7, so up by 1.5%. And US has gone to 3.3 from 0, which is up about 3.3. And Pakistan is now, as an example, I use Pakistan, so let's just mention its government bond yield is at 14.3 from 7.3, or up 7%. So what's the bottom line? The Fed interest rate hiking cycle is sweeping across the world. Let's look at the next thing that I want to talk about, which is looking at the developed countries and see what's happening with France and Germany and the US. So here we can see a chart that I constructed showing the developed markets in the Americas, which is mainly the US, have led the rate hikes. And we can see, actually, this chart is interesting because it just shows how high emerging market rates already were and how high they are. And the blue line that on this chart you'll see is the Americas, which is increasing from 0 up to 3. And so, in fact, you could see that the developed markets, Americas, is starting to close the gap with the emerging markets. And that gap has been very wide. In fact, let me just grab my pen to mention what I'm talking about. I'm talking about the gap between the emerging markets and, let's say, the US right here. That's a 4% gap, but that's a much lower gap now. And so part of the reason why the US dollar is strong is because the interest rate on US dollar is strong relative to other countries. Now, almost all increases in developed markets are happening in the US and the UK. Here we can see the US and the UK, the red and the brown dotted line, have already risen substantially. So French and German short-term bonds are only now starting to rise. So we can see only recently did these start to really rise. So France and Germany have been in negative territory for a long time. And all of a sudden, only August. So this chart shows September, up to September, August, and July. So we can see that they're just starting to increase. Now, if you look at the CPI in Europe, in Germany, in France, it's out of control. So what are they going to do? I would argue that you probably are going to see the ECB or the central banks increasing rates, and those 3-month rates are going to rise pretty substantially. So why is there so much strength in the dollar? Because people are worried that the euro is going to be crushed from inflation because they haven't increased interest rates. So what's the key point and the bottom line that I want you to get from this section? Well, Developed market Americas, which is mainly US, has led the rate hikes. And developed markets Americas is closing the gap with emerging markets government bond rates. And the US and the UK are the only major developed market countries aggressively increasing rates. French and German 3-month government bond rates are only now starting to rise. And Japanese, we didn't look at it, but Japanese short-term yields remain slightly below zero. Now, what is the bottom line? France and Germany are in a painful game of catch-up with the US when it comes to raising rates. And I believe that that is just one more painful thing that Europe is going through. One thing I want to mention here, and I just talked about this for a moment because we're going to look at this in a little bit, in just a little bit, is Japan. When Japan has kept, the government has kept the interest rate basically down at zero. When you keep interest rates so low, what happens? People are incentivized to borrow because interest's so cheap. Now, keep in mind that when the government has interest rates at zero, that doesn't mean that companies are borrowing at zero, but they may be borrowing at 1 or 2 or 3%. So you would think that the Japanese companies would be borrowing like crazy. So we're going to look at that in just a moment and see what is happening with these Japanese companies. Let's go back to the presentation. Before we get to the Japanese companies, we'll go through a couple of other things. But remember, it's Monday morning, 7 a.m. I got to have a sip of coffee. Delicious espresso. So feel free as I go through this to ask any questions that you may have. I know it's early, but you may have a question as I go through. Next, I want to talk about how emerging market rates have been higher but kept low by China and how frontier markets suffer the most. So there's a lot on this chart that I'm looking at. This is emerging market Asia, which has the lowest rates. Frontier markets have run away with their short-term government bond rates. And you can see this chart shows that the frontier markets are basically seeing this huge increase, almost to 20% for government bond rates. I'm going to explain more about what's happening there. But this is looking at mainly frontier and emerging markets. I put in the developed ones right here, which is that red line at the bottom, to show that developed markets is very low interest rates and emerging markets are pretty high, except emerging Asia. And emerging Asia really is China. Now, let's look at the top 5 emerging market countries: China, India, Korea, Russia, and Brazil. China bucks the trend with short-term rates falling from 2.4 to 1.7. China could really go either way. It's a difficult one to call right now. We have a slowdown of the economy and it could keep interest rates low, or a recovery could rev up inflation and demand and interest rates. It's very hard to call right now, but I would say that we're probably still in a low interest rate environment. Now, this is fascinating because what I started off the whole show talking about the power of free market capitalism. Well, we're not operating in free market capitalism. We have a Fed that basically sets the price of money. And they pretty much get it wrong almost every time. They flood the world with cash, and then they don't understand why inflation happens. In fact, you had Secretary of the Treasury, Janet Yellen, expressing kind of, there's no way we're going to have inflation. And then later, we're not going to have a recession. But let's just imagine that we believed in controlled markets where we need government bureaucrats to set the price of money. Well, this is what we call Keynesianism after John Maynard Keynes. And the idea is that when times are tough, the government should spend and decrease the interest rate to try to stimulate borrowing and economic activity. And when economic activity is super strong, they should be tightening, getting more revenue for the government out of that, and basically managing that. But in fact, what we're seeing with the Fed is they're kind of doing a bit of the opposite. I would argue that they are tightening in a really, really dangerous time, like a recessionary time, whereas now should be basically they should have been tightening during the boom that we had. We just had a decade-long boom, and they didn't tighten at all. In fact, they fueled the boom. And so they're forced to tighten now. And this, to me, is what free market is about, is free markets allow interest rates to rise, and participants in the market can't expand so aggressively because interest rates are rising and we don't get such a bubble. I would argue that the Fed caused this big bubble, and I think that the Fed is possibly causing us to go into a global recession. So let's go back. I saw a nice good morning from Wat Tan Yu. Nice to see you this morning. I'm going to have another sip of my espresso. And let's continue on. So also you can see Russia's short-term rates shot up. Now they've come down from there, but right now for my data set, I didn't have the data and I didn't have time to fill it in. So, but you can also see Brazil's interest rates have gone from about 5% up to 15%, a pretty large rise. All right, let's talk about frontier markets. Here is a map of the world, and my goodness, let's just take a look at it in full detail. And what you're going to see is I'm going to talk about in the legend, in the numbers below the country. I'm going to show the the GDP of that country. So Argentina is oftentimes considered a frontier market. It's got $489 billion. And also Nigeria here, it's got $442 billion GDP. Then there's Vietnam at a $366 billion GDP. And then there's Bangladesh with a $357 billion GDP. And then Pakistan with a $348 billion GDP. Then we've got Kazakhstan. And I've talked about Kazakhstan last time, where I think that Kazakhstan is going to become a new hotspot because of all the rare earths that the country has. And then Sri Lanka now becomes a very lower, you can see an $82 billion GDP, which is actually pretty impressive when you consider it's a tiny, tiny little country. And then Jordan here in the Middle East, we can see at a $45 billion GDP. These are what's often called frontier markets. So now I want to add in an arrow, and you can see for Argentina, the top number in that upper arrow box is the current 3-month government bond rate. So you can see it's 70% government bond rate right now in Argentina. And the number below is how much it's up. So it's up by basically doubled. It's up by 35% compared to 12 months ago. Sri Lanka is at 29% for short-term government bond rate, and it's up 22%. So a massive increase. And we can see Pakistan's up 14. It's at 14% for the short-term government bond rate, which is up about 7%. Kazakhstan is at 15%, which is up about 6%. And then Vietnam is at about 6%, which is up 5 percentage points, meaning it was at 1. It has increased pretty massively. So why are frontier market rates rising so much? Well, if frontier market countries attempted to print and distribute money to relieve the pain their populations are facing, their currencies would get devalued in the Forex markets. There's discipline for countries, and the problem for the US is they don't face that discipline because all the printing of money and the government debt is not going to be punished right now with the US dollar. Now, as their currencies devalue, then imports become more expensive, and that's increasing domestic inflation in these frontier markets, since many of the countries are import dependent. They could be smaller countries and they just don't have as much resources. So they're forced to raise rates to stabilize their currencies and prevent runaway inflation. It's a painful cycle. Now, but the US can print money for years, yet the dollar strengthens. This is a chart of the US dollar index. And basically, the US has the privilege of being the reserve currency. So the US Fed can print without an impact on the value of the dollar. But the question is, can they do this forever? And of course, the answer is nothing lasts forever. But it's working right now. So let's sum up what you've learned in this section. Emerging Asia has the lowest rates. Frontier markets have runaway short-term government bond rates. China's short-term rate fell to 1.7 from 2.4. And a slow Chinese economy could keep rates low, or recovery could rev up inflation and rates. It's a tough call, but I would go with the interest rate and inflation being low in China for another 6 more months. Now, frontier markets are hit hard. We saw Argentina, 3-month rate was at 30%, which is up 35%. Sri Lanka was at 29% for the short-term government bond rate. It's up 22%. Pakistan was at 14%. It's up 7%. Kazakhstan at 15%, which was up 6%. And Vietnam is at 6%, up from 1 by 5 percentage points. Frontier markets are forced to raise rates to protect value of currencies and to prevent runaway inflation. Bottom line, emerging market rates have been higher, but kept low by China, and frontier markets suffer the most. Let's continue on and look at how rate rise reduce global earnings. So what's the impact on the profits of companies? Remember, if you have a question as I go through this, feel free to ask that question. I want to welcome everybody here. We've got about 57 people watching on YouTube and maybe on some other locations too. But welcome to the show. If you've got a question, feel free to ask that question as I go through this. I see Jing Jing says, good morning. Good morning to you. And what a fresh and happy Monday morning. Monday is my favorite. I always say, thank God it's Monday. People say, you're crazy, Andrew. Why do you love Monday so much? And I said, because I love work and I love what I do. And I always said that if you love Monday, the rest of the week is going to be amazing because you're going to love Friday anyways, right? So let's continue on. Oh, and I say, Anucha says, how much would higher interest rate affect frontier markets liquidity? Possibly more defaults. I think that there is a serious risk because there's also what happens when these short-term interest rates go up in the frontier markets is that it starts to put a huge amount of pressure on the people in that country who are suffering under this inflation and very high interest rates. And what happens is political upheaval. And we see people out in the streets and we see political change. In fact, I think that we're going to see some of that happening in Europe over the next 12 months as they go through a lot of pain. So I would say, yes, there is more risk of default. And that's part of the reason why currencies are weak. Now, I decided not to talk about foreign exchange this time because it's a little overwhelming. We've already got a lot of stuff here on interest rates. But I think, Anucha, you're right. There is a risk of default. And what's going to happen is the IMF is going to step in and say they're going to provide funds and all that, and they're going to try to stop those countries from defaulting. But it is going to be a very difficult time. So let's continue now and see what is the impact on earnings. Let's walk through some calculations. I love this picture. First, I want to estimate how the increase in the 3-month government bond yield impacts companies. So what I did in this case is I looked at that 3-month government bond yield, and let me get my pointer out here. And what we can see is that it was 1.4% for the government bond yield worldwide, and it went up to 3.4%. That's a 2% increase. So what I did on the right-hand side, you'll see I took that 2%, I multiplied it by 0.75 because I said, well, companies aren't borrowing short term so much. So maybe the longer term rates aren't going to go up as much. So let's say they're going to go up about 75% of the increase in the short term rate. And that gets me to and then what I did is I calculated my estimate of what interest rate companies are paying right now worldwide. So this is a number that I calculated from my data, and that's 3.3%. And that means that the interest cost or interest rate for companies worldwide would go up from 3.3% to 4.8%. So this is the foundation of this research, and I'm going to go through this in a little bit more detail. So the next thing I did is I constructed a common size P&L to the operating profit line. You can see I made the revenue common at 100. I used the revenue as the base. We can see cost of goods sold globally is about 70% or 70 out of 100. Gross profit is about 30 out of 100, and EBIT is about 11 out of 100. This was based upon all companies in the world over the past in the year of 2021. So you can see that globally, gross profit margin was 30% and EBIT or operating margin was 11. If you find a company that's got more than these, then that company is doing better than average. So this data basically allowed me then to go to the next step. And I did this by looking at the balance sheet and income statements of 13,275 companies just to get to this study. So this is a bottom-up construction of the balance sheet and P&L. Now, I did something kind of strange here, but before I do that, let me just explain this part. So once we got the EBIT, so I was showing earlier the EBIT line, which is this final line, the earnings before interest and taxes. We also call that operating profit. And then I said, let's continue down. And from the EBIT, I said, what's the interest costs? And then what's the earnings before taxes? In other words, earnings after the interest costs. Then I did something kind of interesting where I did a balance sheet as a percent of revenue. So in this case, you can see that for 100 in revenue that every company in the world makes, it has 146 in assets. From that, I was able to understand what is the company's debt to equity ratio. And the result is I could estimate the debt and I could estimate the equity and then other liabilities. From this, I can make a calculation. I can calculate how much the rise from 3.3% to 4.8% would impact the interest expense of the companies. And what you can see is it caused the interest expense to go up from 1.3 to 1.9. And that is a 6% increase in the, decrease in the earnings of companies. So what we can sum this up as is say that the result of a increase in the government bond rates globally, we can see that it's causing a 6% decline in the profits of the companies. So a lot of interesting stuff going on in this table. But before we go on, I just want to take a minute and say hi to everybody and welcome to the show. And I welcome you to ask any questions as I go through this. There's a lot of stuff that I'm presenting today, but it's fascinating when we try to understand the impact of interest rates on profits of companies and on currencies and the like. But I noticed some people here, so I just wanted to say hi. I see SB. I'm looking over at this. Did you agree with some experts that predict the S&P 500 will sink below 3,000 points? I still think that there's downside for the S&P 500. I don't make a prediction like that, but I do still think that there is downside. So I would be careful about that. We've gotten a very strong S&P recently, but I would say there are still significant risks. So Suchira says, morning, wow, never have so early live. Yeah, I know. For Phenomena, basically, we usually start a little bit later. So, and let's see, we got another mention from Shiro says, do you think it's a good opportunity to invest in global US bonds? If yes, short-term or long-term would be better. This is an interesting question because basically what you've had is bond prices have been collapsing. This is one of the worst bond market declines that we've seen in the history of the bond market. And the result is that we now have government bond yields at almost 4% or so for longer term yields. Now, what I would say is that it probably is not a bad time to allocate money to US government bonds as an example. Now, you could go to almost any government bonds, but let's just use US government bonds as an example. In the case of US government bond, if you bought a bond today, you would be buying it at about 4%, right? You would be earning about 4% yield. Now, let's just imagine that you bought a 5-year government bond. It was trading at 4% yield. Let's just say you held it for 5 years. You would earn 4% per year. That's not bad. That's not bad. Now, if interest rates started to fall, then what you would see is the value of that bond would rise. And so you may earn even more than that 4%. So Shiro, my answer to that is yes, we probably are at a situation where it makes sense to consider buying some portion of your portfolio into government bonds. So, of course, you've got to look at the currency and some other factors and look at your own situation. I don't know your situation, so make sure you do your research and, talk to your advisor. I know at FINNOMENA, they got a lot of great advisors. So what is the current level of corporate profitability? That's what I wanted to know as I was going through this. So I thought, okay, I've got the data on 13,000 companies, so let's look. And here you can see that I've calculated the EBIT margin. So that is just the earnings before interest and taxes divided by the revenue. We also call that the operating profit margin. And what you can see is that in the year 2000, it barely fell. It barely fell. And in the year 2021, it rose to all-time highs. So companies around the world are at peak profitability right now. So now let's go into our fourth step here and try to interpret the data that we looked at for the world. The increase in the 3-month government bond yield over the past 12 months looks to have reduced corporate earnings worldwide by about 6.2%. So fifth, let's apply this analysis to the US and other developed markets. So here I've now shown, we showed the world, let's look at the US. And we can see the same analysis I did on the US, the increase in 3-month government bond yields over the past 12 months looks to have reduced corporate earnings in the US by almost 9%. So US really got hit hard. This is because the rate rise has been higher in the US than the average globally, and the US has slightly more debt. We can see that the debt to equity ratio for the world is about 0.8, and for the US, it's about 0.9. Let's look at Japan. Japan government rate has actually fallen, and its debt is low. So there is a somewhat positive impact. You're going to say, Andrew, wait a minute. Japanese company debt is low? Yes. Remember, I talked about Japan right at the beginning of this show, but it's remarkable that the Japanese central bank has kept interest rates around zero for decades, and yet the companies have not leveraged up. This shows the disconnect between the government bond rates and corporate behavior. Where can we see this? We can see this in the debt to equity ratio, which is at 0.6 for Japanese companies, meaning they have a lot less debt than the average companies around the world. Now, that's 2,079 Japanese companies that I'm looking at in my data set for this bottom-up analysis. So let's look at Germany. The German 3-month government bonds have gone from negative to positive, but the impact is in line with global. So here we can see it's gone from negative to positive, but still it's pretty low. So negative rates never were available, of course, for companies. Companies always paid some rate. And in Germany, they were paying about 2.2 on average out of the 200 companies that I have in my data set. And basically, German companies have slightly higher leverage and lower profitability compared to worldwide. You can see about 7.9% earnings before taxes versus about 9.7 here we can see for the world. And therefore, Germany is not impacted as much in this case. Now, worse than average for the UK because interest costs were already high. If you look at this, you can see, first of all, the leverage the amount of assets that are required to produce 100 in revenue in Germany and in the UK is very high. They require a lot of assets. And what we can see is that the interest rate in the UK was already pretty high at 4%. And the result is that they have seen more damage or relatively high damage of 7.3% to their profits. Finally, let's look at France. Interest costs in France didn't increase by much. Low rates, government rates in France could keep inflation fired up. Remember, we saw that the government in France has not been increasing interest rates. And as a result, they've just started. The impact is pretty tiny, only 4.8% based upon the increase that we have seen so far. But I would say that French companies are going to be facing some real challenges going forward. And what are the key points? So we analyzed our data set of 13,000 companies. Operating profit margin barely fell in 2020, and in 2021 was at an all-time high. Year-on-year increase in the 3-month government bond yield likely has reduced corporate earnings worldwide by about 6%, and operating earnings in the US were down by almost 9% because of a higher rate rise and slightly more debt. Remember, what we're trying to do is look at the impact of the Fed's rise in rates and how does that impact the earnings of companies by keeping everything else the same. Now, Japan's government rate has fallen and corporate debt is low, causing a somewhat positive impact. And despite decades of zero government bond rates, Japanese companies refuse to borrow excessively. German 3-month government bonds went to positive from negative year on year. And because rates were lower than average, the impact on earnings was in line with the global average. German companies have slightly higher leverage and lower profitability than the worldwide average. And I think that's just getting worse this year. Remember, we looked at 2021 and are estimating the impact this year. So worse than average earnings crunch in the UK because interest costs were already high and they rose considerably. It's interesting about the UK, what you're seeing is that they have less of a reserve currency status. So if they don't keep interest rates higher, they could see the pound get devalued, whereas the US has the ultimate reserve status. They can keep the rates low and still keep the value of the US dollar high. Interest costs in France didn't increase by much, but these low rates could keep inflation fired up and eventually rates would be forced to rise. So what's the bottom line? Well, rate rise reduced global earnings by 6.2%. In developed markets, US and UK were hit the hardest. Let's now look at the last part of this analysis, and we're going to look at the corporate interest costs, which are up to 4.8%. So what's the impact on emerging market companies? That's what I wanted to know. So I grabbed this picture of Shanghai, which is pretty amazing. And let's revisit the world before looking at emerging markets. I'm looking at the same table we just went through, and we saw that the increase in 3-month government bond yields over the past 12 months looks to have reduced corporate earnings worldwide by about 6.2%. That's our first conclusion. So now we're going to look at the emerging markets, not just the developed. The first emerging market is China, and we can see falling interest rates in China means operating profits should rise. Rates went down from 2.4 to 1.7 for the 3-month government bond yield, which basically means that the earnings, potentially the impact of rising rates, actually had a positive impact in China. That's because interest rates are low and falling because demand is falling there. Now, there's a small negative impact on India because profits are high. So we can see that the earnings before taxes are at about 12.7% in India, very, very profitable. And debt is low. Look at this amount of leverage. You can see 0.4. This 2,000 companies that we got in the Indian database in this basically have a very low level of leverage. Korea, well, Korea was hit hard because rates and EBIT margins were low. Korea tends to always have somewhat lower rates, lower profitability. We can see 7.1 here. And what we can see is that the impact was 7.3% on profits. Russia, interesting to see this. There's less impact of the rise on Russia. Why is that? Because the rates were already high at 6.9. They went to 8. And that meant that the corporate rates went from 7 to 7.8. Not a huge increase. And therefore, we do see that it's a small impact on earnings. Now, what you can see from Russian companies is that they are hurting because of the fact that they have a very large amount of leverage. So that impact of the interest costs causes the EBIT margin to go from 9 down to 7, basically. So Russian companies, of course, are struggling. This is 364 Russian companies that we're looking at. So there's less impact for Russia because rates were already high. The change in rates set by the government was small, and asset efficiency is high. Let's finally look at Brazil. Brazil is likely to be hit the hardest due to the massive rise in interest rates. And we can see here that it's going from it's down by 26%. And that's because they got a 7.5% rise in their government bond rates over the last 12 months. And that is a crushing blow to earnings. So possible 26% collapse in operating profit in Brazil because the rate rise was massive. Debt levels are higher than the global average, and the massive rise should stabilize the currency and tamp down inflation if it's successful. So let's sum it up. Expect corporate interest rates to rise from 3.3% to 4.8% as a result of the impact of the Fed's rise. Developed markets, we can see that biggest rise in developed markets should be in the US, and Japan has been reducing rates. US and UK are high interest rate countries. Japan is low. Germany and France are in the middle. And in the emerging markets, we can see that rates fell this year in China and had a small rise in Russia, Korea, and India. And it was a massive rise in Brazil. And then there's a slowdown in China, which is keeping rates low. So let's look at this impact here, and we can see the EBIT margin and the change. The EBIT margin hit hardest in the US, Germany, and the UK, and it rose slightly in Japan. And in the emerging markets, EBIT margin was hit hardest in Brazil, and there was actually an improvement in China. Let's look at the characteristics of the markets. We got high debt in Germany, low in Japan, and asset efficiency lowest in France. And then debt is high in Russia and Brazil, and it's low in India and Korea, and efficiency is high in Russia. So what are the key points that we want to take away from this section of the analysis? Corporate interest costs to rise to 4.8% from 3.3%. The US had the biggest rise in the developed markets. The US and UK are high interest rate countries. Japan reduced rates and is the lowest rate country in the developed markets. Germany and France are in the middle. And rates fell this year in China and had a slight rise in Russia, Korea, and India, and a massive rise in Brazil. Now, a slowdown in China has kept its rates low. And in developed markets, EBIT was hit hardest in the US, Germany, and the UK, and it rose slightly in Japan. And in the emerging markets, EBIT was hit hardest in Brazil and improved in China. Finally, high debt in Germany, low debt in Japan. Asset efficiency was lowest in France, and debt is high in Russia and Brazil, low in India and Korea, and efficiency is high in Russia. What is the bottom line, you may ask? Well, the corporate interest costs are up to 4.8% from 4.3%, and profit hit at the US and UK, Germany, and Brazil's. This is the countries that are getting hit the most. Finally, let's go into the final part of this show today. I want to introduce you to a company that is a defensive supermarket in Singapore. You may have seen this supermarket before, and it's Sheng Siong, and it's a defensive Singaporean supermarket play. Stronger Singapore dollar to have a positive impact on gross margin as Singapore imports most of its food. And the company, SSG, can pass on input costs to customers, 1.5 percentage points gross margin expansion in second quarter compared to first quarter this year. It's a good dividend play at a 4% dividend yield in both 2022 and 2023. This is based upon consensus estimate, not my forecast in this case. Now, the risks are weaker consumer spending and rising food inflation does eventually feed through. So let's look at the company. It's the third largest supermarket chain in Singapore. It provides low-cost essential products to mass market consumers through its no-frills approach. SSG had 66 outlets in Singapore Heartlands and 4 in Kunming, China as of the 30th of June, 2022. The company derives all of its revenue from supermarket operations. Here we can get a picture of it and see that the market cap is about $1.7 billion and $3 million in average daily turnover. The company is controlled by the Lim family there in Singapore, and it trades above the ASEAN consumer staples at 4.8 times price to book. If we consider the high ROE, SSG trades roughly on par with the ASEAN sector. We do something called watching the street, and since analysts are persistently overly optimistic, we force rank all stocks in our ASEAN universe. 1/3 in each buy, neutral, or sell. And SSG is a strong buy relative to other non-financial stocks, and that's based upon the recommendation of 7 analysts. Not my recommendation, but the analyst's recommendation. There's 7 analysts covering the company. Now, we look at 4 elements, FVMR, and fundamentals. Basically, the company's attractive overall in ASEAN. The fundamentals has excellent ROE. Valuation, it's expensive. It's not cheap, but you're getting a high return on the assets that they're generating. And momentum is moderate price momentum and moderate earnings momentum. In other words, they're positive. And risk, well, it's attractive. SSG is net cash and has a low beta. Also, using our profitable growth scorecard, we benchmark SSG relative to 600 large consumer staple companies worldwide. And SSG is world-class on profitable growth. The high profitability drives the rank. That's the ROA, which is very strong. And growth has just been average in the past 12 months. Finally, I would say that the recovery we've seen in revenue and gross profit slowed down a bit in June. So there is some impact there. And what we can also see is that the company's position from a cash flow basis is fantastic. They actually have a negative cash conversion cycle, and net equity is negative, meaning they're a net cash company. And finally, the return on invested capital is massive. So though things have fallen a bit, it's still at a very high return on invested capital. Remember, I don't own this stock right now, and I'm not recommending that you buy it. But in this show, I wanted to highlight some companies that I thought were interesting in Asia. Finally, let's wrap up. Well, Otto von Bismarck said, "Only a fool learns from his own mistakes. The wise man learns from the mistakes of others." I want to introduce you to 3 people I met last week that helped me to reduce risk, and I believe they can help you too. The first one was Dave Clare, and he has led multiple businesses in and through challenging times. He was trying to fill up his unhappy life and thought investing in a community leadership center was the answer. The center only hemorrhaged money and never brought in any revenue. The lesson that he learned that we can take is don't buy stuff just because you're trying to make yourself feel happy. Keep costs at an absolute minimum and drive revenue. The second person was Connor Riley, and his episode in my discussion with him on my worst investment ever was don't throw good money after bad. Connor worked in investment banking, private equity, and consumer products. He invested in a stock on a tip from his workout buddy. That stock dropped during the 2008 financial crisis, so he bought more. Then that company went bankrupt and he lost 70% of his net worth. All kinds of things here, but one lesson we can learn is he says don't have more than 8% of your portfolio in a single thing. Do your own research, and if your investment is going wrong, get out as quickly as possible. Great lessons. And finally, Rick Jordan, be careful when helping friends. This is an important one. Rick is founder and CEO of a recently IPO'd company called Reach Out Technology in the US, and he speaks on cybersecurity and mindset. Now, he told me the story about how he wanted to help a friend by buying his business, but didn't think of including a non-compete clause. 6 months later, his friend basically set up a competing business and took back the clients that Rick had acquired from the sale. Not such a good friend. What did he learn? Get the proper legal structure when buying a business and refrain from letting emotion drive your decisions when investing. In fact, I've learned 6 common mistakes and how to avoid them. The first one is fail to do their research, so do your research. The second is fail to properly assess and manage risk. Remember, research is a lot about risk. The third is driven by emotion and flawed thinking. Try to take the emotion out of your investing. The fourth is misplaced trust. Be careful who you give your money to. Number 5 is fail to monitor their investment. So follow a regular predetermined monitoring process. And number 6, so many people on my podcast, My Worst Investment Ever, have shared the worst investment of investing in a startup company. So just start from the reality that you are likely to lose everything. And that is the end of today's show. Fed-led interest rates rise is spreading worldwide pain. Let me see if I can answer a couple quick questions before we wrap up. So we have a question. What are your thoughts about the Hang Seng market crash? Do you think it's an opportunity? I think one of the things about the Hang Seng or the Chinese, the Hong Kong market is that maybe people are a little bit afraid that it may break away from the US dollar, and therefore we could see things crashing. So that's a possibility. But I would say in general, I'm relatively positive on the Hong Kong market right now. And I think that it's gotten even cheaper. So I would I would say that it's probably an opportunity to buy, but we could have kind of a catastrophe if the Hong Kong currency breaks from the US dollar. Now, the possibility of that happening is pretty low because the reserves are pretty significant. But I would argue that it is now becoming a little bit more possible. Next question is, I don't understand Bank of Japan's decision at all. It seems that companies are not really making use of low interest rate, but Bank of Japan refuses to increase rate to help with the weakening yen. Yeah, well, what you can see is that the transmission of interest rate changes by the Fed or the central banks, that broke years ago, years ago. That was part of what happened in 2008, basically, is they tried to lower interest rates and they found out that companies and banks were not responding to the lower interest rates. And that's where Bernanke was trying to pump more and more quantitative easing into the economy to say, well, if interest rates don't work, then the federal government's going to basically step in and is going to do quantitative easing. And that's the whole reason why we got quantitative easing, because the transmission of the interest rate rises or falls by the Fed was not being transmitted into the overall economy. That was broken years ago in Japan, and that's why Japan is stuck in a very difficult situation. Well, I want to thank everybody for joining the show today. It was fun to go through some of this data, and I appreciate all the questions, and I hope that you have an amazing week ahead.